Hello everyone, thank you for joining us today. Welcome to Rich by REIT, a podcast that takes you behind the scenes of alternative investments here in Canada, as well as explores how Canada's top investors are currently building wealth. My name is Andrew Byrne. I'm the Director of Private Capital Markets here at Lankin Investments, joined by Ray Pun, our President of Private Capital Markets. Ray has helped raise over $2 billion across various real estate investment funds. He also brings 15 years of experience both in the private and public market sector. Today's episode is titled REITs, Tax Strategy, and Market Trends. We'll explore why REITs are becoming a key part of people's portfolios in 2025, their unique tax advantages, and the major market trends shaping the future of real estate investing. Stay with us. Ray will share some insight on how Canadians are accessing institutional grade investments through private REITs, and the current market environment makes these investments especially relevant. If you want to learn more during the episode, please visit www.investing.lankin.com/REITready. The link will be attached just to the top of the chat there, so definitely check that out if you're looking for some more information, as well as kind of how to get started. So let's kick things off by kind of giving an overview of the big picture. From your perspective, Ray, what are the most significant current and emerging trends that are shaping the Canadian real estate market today?
Yeah, Andrew, listen, thanks for having me today, for your hosting, and this is sort of our second session that we're doing, so I appreciate that we're doing this. So let's get into it. So we're talking about real estate market trends. We've seen a sort of a rotation to defensive real estate sectors in the last two quarters, I'd say, and that's really multifamily and industrial. When you look at the transaction volumes that have taken place in both of these sectors, multifamily is around 33%, industrial is around 28%. You put both of those together, that's more than half the transaction volume taking place. So there's a lot of confidence in these two asset classes in Canada right now. Now, when we look at office as another asset class, we haven't necessarily seen neutralization take place post-pandemic, and that's simply we haven't seen workplaces and employees go back to work full-time. Remote work is still prevalent. With that, nationally, there is a 18 to 20% vacancy rate, which is rather high. So what you're seeing sort of a flight to quality. So when you look at Class A office is defined as in a primary market, in a newer building, and or ESG certified buildings. We're seeing those assets are performing a lot better with a lower occupancy rate than B and C stock. B and C stock are generally older buildings in maybe mid-market or cities that are maybe a little bit less desirable than your metropolitan cities. With that, when you have those assets, you're sort of left with one of three scenarios. You can hold the asset, you can reposition the asset, or third, you can sell the asset. But should you choose to sell the asset, you're likely going to be selling it at a bit of a market discount, and that's obviously not favorable. And then the other thing I'll share is in the last, it's maybe a year and a half, what we've seen is we have seen a halt in development. We're not seeing the same rate of development, specifically in the condo sector. There's a lot of news out there on condo vacancies. There's a saturation of new condos, supply coming online in the next, call it 12 months. And we just have generally a soft retail market where buyers are not buying. When you put all that together, but let's say you look at the developer side, soft costs are still high, right? And that's things like permits. Labor and material costs have somewhat stabilized since post-pandemic, where those costs are 1.5 to 2 times higher, sort of in between sort of 2021 to 2023. They have somewhat normalized. One of the good things that have actually happened is that we do have lower interest rates to the tune of 225 basis points in the last 18 months. But what we also see is lenders have tighter provisions. So to access that capital, developers are having a harder time, and that's based on the fundamentals of not being able to sell and not having the fundamentals to get enough of capital to get a project off the ground.
Definitely some great kind of insight there on what you're seeing in the market. That being said, given the current economic landscape, what do you foresee as the biggest opportunity for Canadian real estate investors over the next 3 to 5 years?
Yeah, look, for real estate investors, Andrew, I'm quite bullish on multi-res assets, so apartment assets, rental assets. And there's several reasons. there still is a lack of affordability. I don't want to call it a crisis, but issue in Canada. That's the first thing. Second thing is we do have continued demand for rental, and this is just based on the fact that if we have fewer buyers at the market, renters are staying in place for a longer period of time, number one. And number two, demand is still being driven by immigrants coming to Canada. Lots of information available on this, but as a newcomer comes to Canada, generally speaking, they're not buying their first home immediately. They're renting for something between 3 to 6 years before they have enough of a down payment to get into an asset of their own. We have seen rents in some markets come down as much as 6%, but it's a little bit less, I guess you could say, in some of the major markets. What does that mean? Well, that means that that can have a bit of a impact on valuations. But when you have assets or you're a part of a fund that has a gap to market is simply defined as your in-place rent versus your market rent, that 6% may not be material. And the last thing I'll touch on is cap rates haven't kept up with interest rates. So what does that mean? Well, what is a cap rate? A cap rate is simply, it's a measurement of the value of real estate. There's an inverse relationship with cap rates and interest rates. Generally, when interest rates come down, market valuation of real estate go up. So we have seen interest rates come down again to the tune of 225 basis points, but we haven't really seen a shift in market valuation of real estate just based on a softer demand. So I think it's creating this perfect vortex of creating a great opportunity for investors to be looking at whether it's a multi-res fund or whether it's owning multi-res directly. I think that there's an opportunity for upcoming valuation growth.
Great. So expanding a little bit kind of on the topic of interest rates, how are interest rates and inflationary expectations influencing investor sentiments, specifically kind of here in the real estate market?
Sure. So interest rates are lower, inflation is also lower. Generally, when you have lower interest rates, you have a greater risk appetite from an investment perspective. If we go back a year and a half, 2 years, and 2 years prior to that, we had seen billions of dollars in the Canadian marketplace go into term deposits and GICs at the major banks that were offering higher than normal rates given where interest rates were. A lot of capital was sidelined as a result of sort of the risk aversion mindset because of the uncertainty, and that's a given, that happens. But what we're seeing today is we're seeing a lot of that capital coming out of sort of the term deposits and GICs and coming back to capital markets. The second thing is in a lower interest rate environment, leverage helps. So we're seeing not only retail investors, but we're also seeing institutional investors entering in leverage positions. What does leverage do? Well, leverage means cheaper capital in today's environment. Cheaper capital means the greater for potentially higher returns. And the last thing I'll touch on, Andrew, is inflation hedging is less urgent. So you're seeing also capital coming out of equities and going back, from commodities and going into equities. Gold is somewhat of an anomaly. Gold is still holding strong, but we're seeing a lot of capital going back into the equity markets. And this really speaks to the growth mindset of investors.
Great. Yeah, definitely kind of some great insight there on what investor sentiment is and kind of the market moving forward here. Many of our listeners are very familiar with traditional kind of stock market investments. Could you kind of give us an overview of what a real estate investment trust is, a REIT, and kind of the difference between a REIT and owning, say, a physical property outright?
Sure. So you nailed the definition. Real estate investment trust. That is by definition what it is. A REIT is simply, Andrew, it's a fund or a trust vehicle operated by a company, which allows investors to co-invest alongside other investors as well as the company to go out and buy assets and have asset ownership in a pooled trust. And those assets can be, we talked today about multifamily, it can be industrial, farmland, there's retirement, there's self-storage, industrial retail. So there's various asset classes that REITs are investing in. And really, when you look at a REIT, there's a few things from an investor's perspective that you want to be aware of. Number one is that they're income focused. 90% of the taxable income must be deployed back to the unit holders of the REIT, number one. Number two, when compared to owning your own asset, back to your question, when you own a single asset as a landlord, well, all of your eggs are in one basket. You don't really have diversification unless you own maybe multiple properties. With a REIT, diversification is achieved through multiple properties. You can have cross-border allocation of assets. You have different markets in terms of demographic markets. So you really get more of a diversified pool, or your money is better diversified in a REIT structure versus having a single asset. Professional management is also, I think, very important to talk about. With a REIT, you have professional management from an asset manager that is managing the sort of the financials and the performance, but you also have property management that is overlooking and taking care of the asset itself, so the actual buildings themselves. How does that compare to being a landlord? Well, as a landlord, if your furnace stops working or shingles are flying off your roof, well, guess what? You're responsible for that. You're getting that call. As a REIT owner, you're enjoying passive income, you're enjoying equity appreciation, and you're not having to worry about being a landlord. And the last thing I'll say is both owning direct real estate as an individual or owning a REIT, both are very tax advantageous from a personal and a corporate tax standpoint.
Great. Could you also walk us through kind of the difference between a public REIT and a private REIT, and kind of what the difference would be in those two kind of investment strategies?
Sure, it's a common question, and I think it's a regular Google search for a lot of folks as well. So public REITs are publicly traded on major indices, and a public REIT, they will also invest in real estate assets. It just means that they're a publicly traded company. From an accessibility standpoint, Andrew, if you're a self-directed investor, you can invest by yourself, or you can invest through your advisor. Accessibility for a private REIT is a little bit different. You can get access to a private REIT through an advisor, through the issuer directly in some cases, or through the exempt market dealer in Canada. And accessibility is also through an offering memorandum for private REITs, where there's no offering memorandum on the public side. In terms of minimum investment, in the self-directed space, you could invest as little as a few $100s. So it's very different in the public space versus in the private. Again, based on an offering memorandum, there's eligibility criteria, and depending on how you qualify for a private REIT, depending on some of what's laid out by the issuer, based on the fund, generally speaking, it is a higher minimum investment for a private REIT. I would say the biggest piece that we should be talking about and unpacking is volatility. With a private REIT, you don't really have volatility because the unit price, as they call it, is based on the underlying value of the asset itself plus the cash distribution, and you put those two together, you strip away any debt, and you divide that across a number of unit holders, and that's sort of how you derive your unit price. I've really simplified that. There's a little bit more that goes to that, but just for the sake of the podcast, I want to provide a bit of a simple example. So that's really how it's derived. So really, there's news and events that take place that affect publicly traded companies or stocks. It doesn't affect on the private side, and as a result, you can have potentially smoother returns and smoother distributions in the private space than you can on the public side.
Great. Definitely kind of some good insight there to see kind of the difference between the public and the private there. For someone new to real estate investing, specifically REITs or the Lankin Apartment REIT, what is the kind of different strategy that the Lankin Apartment REIT uses compared to kind of others in the space?
Yeah, sure. So Lankin Investments has been around for over 15 years in the multi-residential space. We are a 100% Canadian owner-operator. So we like to focus on our backyard. We find that there's a lot of value in Canada. So we don't go sort of cross-border and we don't go across waters. We stick to sort of our backyard. That's the first thing. Second thing is we are a vertically integrated company. What does that mean? That means everything from our asset management right through our property management is all in-house. That creates economies of scale. And generally speaking, when you are managing everything yourself in-house, you take a little bit more pride in your assets and you take care of them a little bit better than having a third party with another firm. The other thing that I'll share, Andrew, is when we acquire assets in the multi-res space, we are acquiring, for the most part, only institutional quality assets. So we keep talking about institutional quality. What is institutional quality assets? Simply, they're larger assets, they're professionally managed. Generally speaking, you and I, we can't qualify to even buy these sorts of assets, but in a fund structure, it's a lot easier because it's a pooled investment approach. And when we buy these assets, a part of our mandate is that they must be cash flowing from day one. The other thing that I'll share, Andrew, is what really makes Lankin different is how we manage the assets. So I talked about an in-house property management and an in-house asset manager, and really how we manage our assets differently. We adopt more of a active management approach to our assets as opposed to sort of passive, which really relies on market valuations to drive your unit price or your overall value up and or gap to market. I would say every operator in the space, yes, will pull those two levers, but I can certainly say that Lankin adopts and pulls a lot more levers than that to drive value for investors.
Great, thank you for that. So moving kind of to everybody's favorite topic, tax efficiencies. How does the structure of a REIT generally provide better tax advantages compared to, say, a traditional investment?
Sure. So Andrew, with a REIT, as you're aware, distributions, so your tenant checks come in and we deploy cash flow back to our investors, or a REIT does that. That is a return of capital. In the case of Lankin, we have been able to offer 100% return of capital. Now, every fund may not, but just for the sake of my example that I'm about to share, I'm going to base it on 100% return of capital, which is a world that we live in. What does that mean? That means that the distributions that you receive every month or every quarter, depending on the fund, are tax deferred. So let's walk through an example. So if you have $100,000 invested in a fund, and it's 100% return of capital, and you have an 8% yield. 8% means you're receiving $8,000 every year of distribution. So as you receive that $8,000, whether you take it to your bank account or whether you do a DRIP, you reinvest it, that is tax deferred, meaning that when you do your taxes the next year, you're not paying any tax on that because it's 100% return of capital. So in this scenario, $100,000, right, is your investment. $8,000 this year is your distribution. Effectively, what happens is your adjusted cost base or your book value drops now to $92,000. So until that book value hits zero, that's when capital gains are triggered. But it takes a number of years for that to happen, and until then, your distributions will remain deferred until sort of that book value goes to zero.
Great. And one thing to note too with that is you kind of get that tax efficiency both through the limited partnership as well as through the trust there. Kind of the additional benefit, I would say, for the limited partnership for kind of accredited large investors looking to invest cash, they kind of get that expense flow through tax advantage. Can you kind of expand on that and kind of what does that mean and kind of why would investors be looking for that and why can they take advantage of that?
Sure. So we just talked about the return of capital on distributions. At disposition of a fund, meaning when an investor generally sells a REIT, it's considered a capital gain, not employment income, not business income. It's generally a capital gain. So sort of that's your second tax advantage. And in the development space, and there's few funds that also offer the LP structure. Both of Lankin's funds, of course, offer the LP structure. The LP structure is for non-registered, it's for cash investments, whereas the trust structure is better suited for registered accounts. Now with that, what's the benefit of the LP structure? Well, the legal entity is a GP-LP partnership effectively versus the trustee holding the assets under the trust. Well, what does that mean? That means that the fund has the ability now to flow through the expenses of the fund itself directly to the LP unit holder. Now, when the LP unit holder is flow through, the tax flow through, every year they receive what they call a T5013 tax slip. What is a T5013 tax slip? It's a tax loss slip that now that investor can use to offset against dividends, capital gains, business income, or employment income. So really what you're receiving here is, we talked about tax efficiency a lot, even in the previous question, but now to actually break it down, there's sort of the trifecta of tax efficiency with a REIT model.
Great. So kind of moving into the last question here, more around kind of piggybacking on those monthly distributions. The Lankin Apartment REIT offers a distribution reinvestment plan, so a DRIP. How does participating in the DRIP with a 2% discount on unit price further enhance tax efficiencies and ultimately helps with kind of long-term growth?
Sure. So you've already sort of nailed one of the first things there is receiving a 2% discount. There's of course the advantage of taking the discount, because what's happening is effectively less of your capital is issuing you more units. So that's an immediate win at 2% there for you. When you also take your monthly distributions and you reinvest them, what you've now done is you're also compounding your returns. Now, when you compound your own returns, really what you're doing is it's your own distributions are creating more wealth for you. In terms of tax efficiency, it doesn't matter whether you reinvest your distribution or whether you take that distribution to your bank account. It's the same tax advantage. And really, just to sum this up, is you don't have to reinvest your distributions. You're very welcome as an investor in most funds to take that distribution to your bank account and use it as passive income. You could use it for just general savings. You could use it and parlay that to sort of taking on a big trip, big family trip, or we see a lot of folks that are approaching retirement or that are now in retirement. They take that passive income as their cash flow to live off of.
Yeah, that's one great point there too, is I know I have lots of clients that kind of opted into the DRIP originally there, and then once they moved into retirement, opted to have that DRIP go into their bank account to kind of pay for expenses and supplement that kind of lost income there from retirement. Well, Ray, thank you so much for your time today. It was great speaking with you about these various REITs and tax efficiencies and everything like that. Definitely gave us some valuable knowledge today.
No, thank you for having me, Andrew. I look forward to doing it again with you.
Perfect. And I want to thank everybody that was on here live, and thank you so much for your time and your interest. If you want to learn more, again, the link is attached to the chat there. It's www.investing.lankin.com/REIT ready. One thing to note is I'll also be hosting our second webinar there in the webinar series, the Real Estate Fund Playbook. So definitely, if you have time to check that out, we'll be sending out a series of emails with registration links as well as some more information. So make sure you keep an eye out in your inbox there for those emails. And if you have any questions, please do reach out to myself. I'd be more than happy to answer those for you. Thank you so much, and hope you have a great evening.